And global equities responded to these sanctions as volatility once again returned to the markets. Stocks in Europe fell as much as 2% on Tuesday as world leaders made announcements, but were able to recover much of the losses. In Asia, the Shanghai Composite, Hang Seng in Hong Kong, and Japan's Nikkei each saw losses of between 1.5 and 3%.
Now here in the United States, markets dropped as President Biden announced sanctions on Tuesday, and Russia's MOEX lost nearly 11% during Monday's trade amid foreign outflows. Now, while markets around the world responded the following day, or at the very least were flat or kind of up, in the U.S., the sell-off continued into Wednesday afternoon. This all comes as equities in many nations had already felt significant losses from their most recent highs. So joining us now to discuss the state of markets is Michelle Schneider. She's a partner and director of trading research and education for MarketGauge.com. Always a pleasure, Michelle. I mean, how much has this issue between NATO and Russia affected investor sentiment? I mean, do you expect this to go on as long as tensions run high here?
Well, this actually started before the Ukraine-Russia, and I know that you actually inferred that before. And by the way, I just have to say, following Professor Wolff is a tough act to follow. But what he said is, that's what you discussed. So let's talk about that. We have talked about on this show, really since November, that if you look at the index of the small caps that represents really the manufacturing and industrial side of the United States, that actually started to go down well ahead of this. Inflation, as you well pointed out, has been going up steadily over the course of the year. So what this really does, besides give a new topic for people to discuss, it really now takes a situation that was very difficult to deal with, which is slow growth and high inflation with still labor issues and supply chain and all the rest of it, and now exacerbates it to a point where that super cycle we were talking about with commodities really is here. And as long as these tensions go on, that will be the fuel to keep that super cycle gaining momentum to the upside.
Yeah, and it feels like just one more thing, another new week, another new event. And I know a lot of times when we look at markets, we look at sort of the patterns that we're in. And over the years, we have always heard that this event or that event is priced in. But whether it be rising inflation, the future of Fed policy, or geopolitical tensions, are markets just reacting to crisis after crisis right now?
Absolutely, and you bring up a good point, because one of the questions that traders like me have always had, which is what comes first, the technicals or the fundamentals? And we started to see the technical signs of this a while ago. I mean, even if you look at the most ultimate risk-off, risk-on indicator, which is high-yield junk bonds, they started to downturn in September. So these were in the works. So now with all of this stuff happening here, with all these different crises, one after another, and then, of course, just the whole skepticism of how much the United States can do to stop any of this with the low ratings that we have now with our current administration, it does make you feel really uncomfortable as an investor. And even though we've habitually been buying the dip for the last couple of years, enter the Fed, that has really been yet another sign that I can't even tell you how difficult this is going to continue to be for the Federal Reserve now. How aggressive do they need to be to stop this inflation and yet kill the market and the economy, which is already so limping along?
Well, right, and absolutely, if what Professor Wolff said in the previous segment comes to fruition, which is prices are only going to get higher, how can you respond to that if it never became transitory, as Jay Powell said, and other factors are actually going to contribute to this even further? Now, another thing I know we've talked about before, Michelle, is here in the United States, the S&P 500 and NASDAQ, they're already in correction territory, while the Dow teeters on being 10% off recent highs is about 9% today. Are we at risk of a bear market in 2022, and what impact would that have, considering all the other factors we just talked about?
Well, I like to look back now at history, because we've talked about this, all of us together, about what happened between the years of 1966 and 1982. And we're seeing so many parallels. Of course, back then we had Vietnam War as our geopolitical situation. And then we had the oil war, the Yom Kippur Wars, which really affected, and the oil embargoes. And so now, even though the scenario has changed, essentially what happened during that time was the market didn't necessarily go go into a bear market. It went into a stagflation market, which basically means it stagnated and traded within a range for 15 years. The Dow was at a peak of 1,000. It dropped to 600. So let's take a look now and put those numbers, what we have right now. If we look at a 40% range and you look at the peak of where, let's say, NASDAQ was, we're already down about 20%. So maybe we can go down another 15, 20%. But at that point, I do believe that a lot of these overvalued companies that we've seen will start to look super attractive. And that's when we can really start to chop around and be range bound, not necessarily see huge growth, but not necessarily a sustained bear market either.
Well, and that's interesting because it's something that we haven't seen at least for the last decade, which is, just kind of going along flat because everything, it's always either going up or going way down right now. So Michelle Schneider, partner and director of trading research and education for MarketGauge.com. Always appreciate your insight. Thank you so much.
Thank you.